Good afternoon, folks. Once again, Wes Ashton here today with our session, chatting about a topic that a number of you had identified as a session that you were hoping to see based on our survey we did a couple months ago. So I just like when Teresa, our chief investment officer here at Harbourfront, was a guest speaker 2 months ago. I joked that everybody that was here was hopefully or more so looking to listen to her more so than me. So keeping on the same direction, I will speak very briefly today and turn it over to our guest speaker, Pashby, and we'll walk through the session. Just a couple housekeeping notes. If you do have any questions, which I'm sure there will be some throughout the session, you can just type it in the Q&A box. You can find that generally at the bottom of your screen. Click on it, ask questions kind of throughout the session. We'll do our best to answer them as we work through, or we'll do it at the end. If for whatever reason we can't get to all the questions, if we get an overwhelming amount, we'll try and get back to you one-on-one thereafter. So without further ado, I'll jump right into it. So again, the agenda today, we're going to be talking about how to navigate the estate and how to reduce CRA as your biggest beneficiary. We're also going to discuss how to keep the second property in the family. When I talk about second property, some people talk about cabins or cottages. A lot of folks don't realize the tax liabilities that they have with this. We call it second property because some folks on this call will have investment properties, which have the same tax issues. So cabin, cottage, investment properties. And then we'll spend a little bit of time on corporate taxation, how to maximize your company's after-tax income and assets, and how to get money out of the corporation tax-free. I know there's likely quite a few folks on this call that aren't incorporated or don't have a corporation, but we wanted to touch base on a number of different topics. Again, I think the key thing about this topic of discussion is really it's about getting started. Everybody's situation is a little bit different. And for a lot of folks, they just don't know where to start. So hopefully this session will be educational, prompt you to ask more questions, reach out to us, and get the ball rolling with whatever questions or needs that you guys have. So as I work through this here, I'm going to, like I said, spend 3 to 4 slides here, just chatting a little bit about what does estate planning mean to most Canadians. You know, we're going through a significant wealth transfer in Canada. There's going to be a significant amount of wealth that transfers from the current generation down to the next generation. And they estimate it to be over 1 trillion over the next decade. And factors that are going to affect that will be anything from economic growth, obviously market growth, real estate prices. Real estate is going to be a significant transfer of wealth because we've had such significant gains, especially here in Vancouver. And then I added this one here as changes to the Tax Act. So this could be pretty significant. Obviously, you know, we saw some changes last year that were proposed to the capital gain exemption or the inclusion rates. These can have fairly significant impacts on tax liabilities with second properties, cottages, investment accounts, and so on. No, unfortunately, we don't have a crystal ball on what CRA will do next year. But obviously, they've talked about changing some of these tax rates. So we'll just have to manage it as best possible. And I think the best way to actually address it is to be proactive with your planning when it comes to the estate. So when we look at actually the ideas of legal documents, whether it's a will, power of attorney, health directives, a survey was done recently, and when they asked Canadians, 91% of Canadians thought wills were an important part of the estate planning. Folks, it really is. You know, we're going to talk a little bit about, you know, why people don't get started. Perhaps people don't think they have enough wealth or what have you, but a will is the foundation of an estate plan. And if you don't have directions via a will, you're essentially leaving the direction of your estate up to the courts. So it's really important to document your wishes to make sure that your assets are getting to the right folks. From a power of attorney point of view, so that's from a financial perspective, if something were to happen to you, 86% of Canadians think that appointing a power of attorney is important. And the last one is 77% feel it's important to actually talk to their healthcare providers, their families, and so on about their wishes, you know, if something were to happen to them. Well, this is what they say that they believe is important, but the reality is the execution is the problem. So 70% of Canadians do not have an estate plan. And so if they don't know how much tax, if they haven't done the calculations, they don't know what the amount is going to go to the government, I'll guarantee you they've done nothing to address it. Okay. So as I mentioned, over 90% of Canadians feel a will is important, but less than 48% of Canadians actually have a will in place. Okay. From a power of attorney point of view, over 80% felt it was important. Less than 65% of Canadians have appointed a power of attorney for themselves. Folks, if you have a joint property with a family member, a spouse, or what have you, if you do not have a power of attorney in place and something were to happen to you health-wise, or you became incapacitated, folks, that spouse or partner or family member cannot deal with that property without having a power of attorney in place, or they have to get one put in place. Okay. And then on health directives, folks, less than 7% of Canadians have a health directive in place of how they'd like, them to be treated from a health point of view if something were to happen to them. And a power of attorney and a health directive are two separate things. So why do people not have these in place? Okay. So I think the first one, which is listed here, is it's an uncomfortable topic. We all have to deal with it. And I often say it's never pressing until you're forced to deal with it. Okay. You happen to have a health scare, or maybe a family member or a friend has a health scare. All of a sudden, this becomes really important. You start to reflect on your own, and now you run around trying to get things put in place. Okay. I believe that is the number one thing. The next one is a lot of people feel they don't have enough wealth. Okay. If you have dollars, if you do not name beneficiaries or have a will, again, the courts are going to they're going to disperse those assets. Okay. A couple of ones here that actually stand out is I just don't know where to start. So today is one of those things where we're hoping to provide information, educate you, to get the ball rolling, get you thinking about what should you be addressing sooner rather than later. Okay. The other one at the bottom, I already do advice. So folks, we have a great network of lawyers, accountants, and so on. We can always get you guys started with the proper discussions. And some people just feel they need a formal estate plan or a will. I can tell you my experience, folks, people that feel like that today come to the point in their life when all of a sudden, again, it's important. Every person wants to have some sort of an estate or a will in place. Okay. So a couple of things. I'm going to introduce Brad in 1 second. For those of you that don't have really any documents, you don't have a record keeper, what have you, I just thought I would point this out. We have this family legacy estate guide on our website. You actually go on to oakwaterwealth.com. It'll pop up in the bottom right-hand corner. It's absolutely complimentary. You can click on it. It's about a 30-page document where you can actually start to add a lot of your family details, your records, your passwords, and so on and so forth. It also has great information about who you should actually be calling if something were to happen. It's essentially a guide that goes amongst your legal documents that your executor or family members can actually take, and they don't have to try and track down all of your assets. So if you haven't done it already, go onto our website, download it. And like I said, at least you can have a reference on some of the pieces in there that are relevant. Okay. So that's it for me today, folks. I will, as questions come in, we'll do our best to answer them. We already have a few questions that are already coming in. So without further ado, I'm going to actually introduce today's guest speaker. I'm super excited to have him. Brad Pashby, he's a certified financial planner. He's a chartered life underwriter, and he's a trust and estate practitioner. So he's really well versed in this topic. His background connects two important areas when he's problem solving with the families. So he has a degree in the analytical studies of science, and then he also has the communicative expertise of a degree in education. So together, he's a great teacher. Like I said, really humbled that we have him here. And he's held multiple leadership roles and director appointments, at a lot of great organizations, Vancouver Port of Trade, the Society of Trust and Estate Practitioners, and so on. So with that, like I said, Brad, thank you for joining us today. We're super excited. We got a full room. I'm just going to turn it over to you, and I'll leave it with you, and I'll work through these slides as we go through it. So thank you for being with us today.
Great. Thanks, Wes. And thanks for having me. Everyone can hear me okay here, I hope. Yeah, we're good. Okay, excellent. Well, great. I appreciate the chance to come today and speak to you all. I can't see you, but you can see me. So, we want to make sure you can get as much value out of this as possible. Wes hit on some really critical points about this topic. Number one, it is not fun to talk about. Let's just call that out. But is it critical? Yes, of course it is. Not to get too deep into my own personal history, but dealing with a family passing in the last year, quite organized. My family is, but still, it can be a little bit awkward and clunky, and the emotions come in. So, doing some proactive estate planning, understanding where to begin, which tools to start with, talking to Wes and your advisors at Oakwater, and really trying to connect with those correct advisors to really get set up is a crucial bit. Really, I'm a recovering control freak, so I like to know that once I'm gone, my family can be well taken care of. So obviously, I'm a fan of doing my own estate planning and using the tools at hand to go through. So today we're going to go through a number of different topics. Wes, if you wouldn't mind advancing the slides for us, that would be really helpful. As Wes mentioned, thank you. We're going to look through these three main topics. Now, a couple disclaimers here. First of all, yes, I've been in financial service world and estate planning for a number of years, but I'm not a lawyer and I'm not an accountant. And even if I were, as I'm sure Wes would agree, it takes a team here to really help advise. So, please seek your own independent legal and accounting advice. I'd recommend going through Wes and your advisor at Oakwater and Harbourfront to really make sure you can connect with ones that understand your wealth, your situation. That's really critical. So today we're going to talk about a number of issues. I hope that they all are very applicable to you. They may or may not be, but hopefully they can provide some info and some intel on what to do. So let's just jump into it, Wes. Disclaimer, see your own people, etc. So number one, reducing the CRA, which of course is the Canadian Revenue Agency, as your biggest beneficiary. Slightly tongue-in-cheek here, but the reality is when one passes, there is quite a lot of money flow that happens out going towards the CRA. Now, in Canada, we don't have an estate tax per se, as they do have in the US, but when you die, there are many taxes due. So whether you call it an estate tax or capital gains taxes or whatnot, upon passing, there are many deemed dispositions and transactions which have said to occur, which causes taxation. And I'm sure many of you know this already, but a lot of times a refresher on some of the basics might be helpful. Now, again, if you know all this stuff, fantastic. Please take this info and pass it on, whether it's to your adult children who are getting themselves organized, whether it's to neighbors or friends or family members who maybe don't have the same level of connectivity with their advisors like you do. It makes sense to pass this stuff on. So probate, beneficiaries, joint accounts, and multiple wills. Let's get into it. So first thing is, let's go to the basics. What is an estate? Okay, so there is a big misnomer that an estate is only for ultra wealthy people, right? But actually what happens is when anyone dies in BC, as it says here, estate basically is, kind of a circle. Everything goes into that circle. There's all your assets, all the pluses, all your debts, the liabilities, and those cancel each other out. Whatever's left is your estate. Now, you think in a perfect world, that estate would then just pass on to your kids, grandkids, whoever's in your will. The problem is before it gets there, the government gets their hands on it, surprise, surprise, and takes a chunk of it. So it's important to think about this estate. Are there things we can do to get assets we have today down to the people we love without going through the estate? Because that's a pretty neat trick. If we can do that, what it means is that we're actually doing estate planning without any assets going into the estate. Okay, so that's an interesting kind of piece. Whatever is left in your estate, that's what gets managed, distributed according to your will. So whatever's in the estate goes through your will. If it doesn't go through your estate, it doesn't form part of your estate, doesn't go through the will. Now, I'm kind of burying the lead a little bit here, as they say in the journalism business, but we'll get around to that a bit. The last thing here is about BC's intestacy laws. Fancy word, great for Scrabble. Intestacy just means if you die without a will. If you die without a will, you still have a will. There's a default will, which is jurisdictionally under provincial jurisdiction, which indicates how your assets get divided, etc. Also critically, if you have children, guardianship of children. So today we're looking really very much in terms of from a financial context for wills and estates. But if you do have children and or grandchildren, for example. Really important piece. Wills are critical for anyone who has got any assets and, of course, any dependents on them whatsoever. Okay, that's an important piece. That's actually a question we get asked a lot. Well, Brad, I don't even need a will. Why do I need a will? I'm not some oligarch here with tons of money. Yeah, we'd highly disagree. Wills are the most critical piece of an estate plan. And, for the few $100 it might cost to get done, makes a lot of sense to do. And actually, this is a little bit off script, but, there are things like will kits out there, which, you can buy either in various stores or on the internet or whatnot. Again, not being a lawyer, we're not giving you legal advice here. However, as many of you have had any legal exposure in your life, where that comma sits, the therefore and there are's and all the legalese, it's critical to understanding the intention and, of course, the delivery of how any legal document goes. We highly recommend going to see a lawyer and getting that taken care of. Again, talk to Wes and his team, and they can either direct traffic or help discuss with your advisors. Wes, question?
Yeah, I was just going to say, I had a client years ago actually say that, everybody of age actually has a will. The difference is whether they've given direction or they're deferring that to the courts. And I thought it was really eye-opening because, again, your estate is going to get taken care of, but it's whether it's on your wishes and direction, or you're leaving it up to somebody who doesn't have a vested interest that essentially just looks at it, from a high level and then disperses it. And we've seen these problems as families go through the estate process, unfortunately, where things aren't getting into the right hands. And so, again, going back to it, the will is the first piece of it. And again, I think that's critical. If you don't have a will, and this is something when we do our strategic planning meetings, it's one of the first things we ask, hey, have you updated your will? And of course, everybody kind of chuckles and says, no, it's on my list. But again, passing away without a will, it complicates matters. So I just thought I would add those 2 cents.
Very, very, very well said. And just to dovetailing on that with your power of attorney discussion, we're not going to talk about powers of attorney in this presentation per se, but obviously you need to get a will done before you pass away. But getting a power of attorney done before there's any incapacity is critical. Unfortunately, we've all had people in our lives with various forms of dementia and incapacity that kind of comes and goes. Once someone's lost that capacity, they can no longer make power of attorney. So it's a simple document to do. It's something that can be discussed, and important things. Again, we're not trying to, scare everyone here into action, but it's one of these things where the little bit of effort and a little bit of money it takes to plan ahead is going to pay massive dividends down the line. And that's great. Okay, let's fire on the next slide here and see what we're doing. So probate, so we talked about that. So your estate gets formed, it kind of goes into one big pile, pluses and minuses cancel throughout. But then government, like in BC, takes a slice of that estate just for fun. Every province has different probate fees. We typically say it's 1.4% in BC. As you can see, it's a bit of a sliding scale. So if the amount of your estate is between 25 and 50,000, it's a smaller amount, but it's effectively over that amount forms your estate, and that's 1.4%. So again, just to back up, it's whatever goes into your estate. So if we can do some proactive estate planning and have assets or other sorts of tools which actually never form part of your estate, in other words, they're non-probatable, well, that helps. That's going to mean less money goes to CRA, and still your wishes get done the way you want. So that's going to be the idea here. All this is, it's very proactive work, but it's important to do. Some folks say, well, this is great, Brett. I love this. Let's go all the way. I want to make sure I pay no probate at all. Well, I appreciate your spirit. The issue is there's still maybe some cash flow needs of your estate. So I would just caution folks on going too deep on that road and saying, I want nothing to ever form part of my estate, because if there are costs and whatnot left in your estate, it's got to come from somewhere, and it becomes a bit messy from an estate point of view. Again, the idea of estate planning for me is just to leave things behind in a less of a mess, right? And so if we can take these things into account, that matters. So probate, what is not subject to probate? So basically everything is, except for, and Wes, if you could advance the slide, we'll go into some aspects which are non-probatable. So jointly owned property. I mean, you kind of know this already, right? If you own a home with your spouse and you pass away and it's jointly owned, nothing really happens. It passes over to them directly. Other sorts of joint accounts, etc. There are a couple different kinds of joint ownership. We're not going to get into the weeds of that, but this is one aspect of a non-probatable asset. In other words, someone passes away, it does not form part of your estate. That's what non-probatable means. Any assets that have a designated beneficiary. So the first thing I think of would be life insurance, right? If I name my spouse on my life insurance policy and I pass away, that money, which is tax-free, does not form part of my estate because I've named a person, or could be a charity or anything else like this. It goes around my estate directly to that entity or person or people I wish, without forming part of my estate. Good thing. There's many kinds of other assets that have designated beneficiaries. I'm sure right away you're thinking, hold on a second. How about some of my investment accounts, RSPs, TFSAs, et cetera? There's a few other aspects like that which can do. Assets that are held in trust. So trust is a bit of a loaded word because there are individual family trusts which you can build. There's trusts that are meant specifically for life insurance, which can be happening after you pass away. There are kind of joint accounts, sometimes for minors, that people used to have in trust. We don't really see that quite as much anymore for a number of reasons we're not going to get into. But these are all potentially non-probatable assets. The second last point here is Aston a second will. Now, if you've never heard of having a second will, I don't blame you, because in British Columbia, there's only been something which you've really seen the last, I'd say 5 years, but it might be a couple more than that, but recently-ish, where a secondary will or the multiple will strategy is something which is employed more and more and more of the folks that we see. It's been used in provinces like Ontario for a very, very long time. Again, this falls under a provincial jurisdiction. And the last aspect are private company shares. So if you have a holding company with some holdings, if you have an operating company, it's a privately held share in an entity. Those are also not probatable. And because a lot of folks that do have corporations have a lot of their wealth tied up or built into these shares, it's an important factor for how your estate goes. So as Wes mentioned, that you may or may not have private company shares in your world, but if you do, certainly something to think about. Thanks, Wes. Let's go ahead to the next one. So executors, this does not say executioners, which unfortunately someone misread in a previous session, but an executor is the person who carries out the wishes in the will. Now, I obviously can't see you, but if you have been an executor, I can feel your angst, because being an executor is a very thankless job. It's a very emotional job often. I mean, first and foremost, someone that you loved has passed away. Okay. But then to have to go in to deal with whatever plans or lack of plans have happened and read through it and deal with the financial aspects and then the wishes and all the other people and whatnot, it's a very tough job. Now, this person manages the estate, they pay your debts, they file your taxes, they work with other advisors. An executor is a tough job. If you name an executor, you got to figure out who that person should be. Now, many of you, I'm sure, have wills already. Okay. When was the last time that was updated? As Wes alluded to before, yeah. We'll do this, after the summer, after we get back from our cabin. It's always one of those things. It's never the right time to do. When you do update your will, I highly recommend reviewing who the executors are. Are they still people who you feel are trustworthy and will do the best for your family and estate when you're passed away? A few different points here. I'll use my example. I've got a really great friend named Chris. Chris is one of my best friends. He would likely take a bullet for me if he needed to. Chris is not so good with numbers, and he's not so great with money. I love the guy to death, but Chris would not be someone I would choose as my executor. Heart of gold, would no way, shape, or form be able to handle the financial nuances of dealing with my estate. He's not the right pick, right? Even though he ticks a lot of these boxes, he doesn't have all the skill sets. Some people name multiple executors. So you could name, your spouse's older sibling and your youngest sibling, for example. Maybe their skill sets match up nicely to make it work. Jurisdiction is critical. So again, these are all kind of points with which to be armed to go speak with your own lawyers about, but jurisdiction is quite important. So does your executor currently live in BC or at least in Canada? For example, if they've moved to the States or Iceland or India or wherever, it changes things a lot. Not from only a logistical point of view, but sometimes from a legal point of view in terms of what they can and cannot do. Important to update that, right? So again, if that's the one takeaway, oh geez, who are our executors, honey? Great, go check out your will, review with Wes and his team, and then you can go to your lawyer and get that updated. which is great. Wes.
So, Brad, can I ask you a quick question here? And sorry, I'm just toggling on and off camera here to kind of give you the
That's okay.
spotlight. But you talk about executors. What are your thoughts between a professional trustee versus I've already kind of known about a family member, but can you explain? I know in Canada there's not a lot of professional trustees. A lot of businesses are kind of getting out of it, so they're harder to find. But what are your experiences or comments about that?
Yeah, great question. I think we do allude to it a little bit later in the presentation, but the point is really well taken. There's the practicality point of view, and then there's the cost point of view. So I'll just kind of lay it out. So actually, let's go ahead one slide, Wes. I think we maybe talk about some of the fees in here, perhaps. I'm not sure if it's on our next slide or not, but we'll, hey there, perfect. So in BC, at least, executors can be paid for their services. Now, in practical purposes, in my experience, if I'm the executor on my, say, sister's estate, I'm not going to ask to get paid, because that's not the point of doing that. But you can get paid up to a 5% gross value of the estate, which, throw some real estate in there or whatnot, could be a big number. To answer your question, Wes, about that, if you're a corporate executor or a trustee, which does this professionally, of course, they're going to have a fee and a cost for doing this. That right away may dissuade one from wanting to do that because they want as much money as possible to go to their loved ones. The flip side, though, is the practicality piece. What if there is not an executor in your family who you think could be somewhat unbiased and could be able to handle the pressures? Because if that's the case, and you'd like to have a separation so that your adult children don't fight over things, etc., then maybe paying a fee to a corporate or a corporate executive or trustee is something you want to do. That sort of answers your question, Wes. It's obviously on a case-by-case basis. One other thing I will say is that when you do update your will, speak to your lawyer about this, but you can give your executor the powers to speak with other advisors. So for example, if your estate is a bit more complicated and your executors are not actual accountants or lawyers, you can give them the power to go and connect with said professionals to get really good advice to make sure that it's done correctly. So as an executor, you're not really on your own, but from the lawyers I've worked with, they always recommend providing enough powers to the executors so they can go and actually use other advisors in the process. They're still the executor, but they can kind of bolt on professionals to help them to guide them through the process. So it is quite a big thing. So great question. WESA. So WESA is the Wills and Estate Succession Act. Kind of sounds exciting, maybe or maybe not. Probably doesn't sound exciting at all. Why do we care about this? Well, this is not a deep legal discussion, but the upshot of all this is this whole idea of wills variation. And it's a bizarre nuance that in British Columbia, where if I have adult children and I pass away and I leave it all to kid number 2 and not kid number 1, and kid number 1 doesn't like that, they can actually sue the estate and they have rights. So it's really critical to make adequate provisions for maintenance, support of spouses and children and whatnot. The definitions of who are dependent on you is very, very broad. It's not as simple as you think. So the point of all this is not really to frighten people, but it's to really think about estate planning beyond just the will. The will is a really critical piece, the most critical piece, but things like estate equalization, which maybe you may have talked to Wes and his team about before, but the idea being if I'm leaving my business, for example, to one of my children, and I'm not leaving the business to the other child because they don't want it, what am I going to do proactively to make sure things are sort of fair? I'm using quotes on purpose because that can be seen in many different ways. Is that from a pure number point of view? Is it from an opportunity point of view, et cetera, et cetera? But there are some really interesting strategies, for example, using life insurance to provide life insurance to some aspects of the family and maybe assets to others, right? And so it's a broader discussion about what your plans are. The will is going to be an important piece to do that. So be aware of WESA. Your lawyers obviously know about this inside and out, and make sure you understand, how that best fits your strategy. So the multiple will strategy, we'll kind of finish off here. This is when you actually have 2 separate wills. So you have a will for your probatable assets. Again, just to back up, a probatable asset is basically everything except for ones that don't form part of your will, right? We looked at that small list before. So non-probatable assets are going to one asset, one will. and the other would go into a separate will. So it's important, again, jurisdictionally, it's really critical. If, for example, you have a cabin in Alberta or Quebec or somewhere else, or assets in other provinces, not in BC, it's important that the wills address those aspects, the details of which are far beyond the scope of this discussion. But certainly some, if you fall in that category, then please do speak with your accountant and lawyer about that. If you have a condo or some house down in Palm Springs or Arizona or somewhere else, or Hawaii, really critical, of course, the cross-border piece. You may have had advice on this already, but for a whole bunch of reasons, notwithstanding U.S. estate tax reasons, important to take a peek at all those. And then one of the big pieces that I took away from a multiple strategy session I was at many years ago was a terrible kind of negative loophole that some folks don't do, is naming separate executors for the separate wills. For some legal type reasons, it's important that those two wills actually have separate executors. And again, beyond the scope of this, but if you find that you've got a estate that has some probatable and some non-probatable assets, specifically significant value in private company shares, the multiple will strategy might be something you wish to take a peek at. So I think we'll leave that at there, but we often get a lot of questions about that strategy. We kind of divert those back to your lawyer. Thanks, Wes. Beneficiaries we mentioned, pretty straightforward. I'll just top on that, the last topic there of segregated funds. It's an investment type, which you may or may not be aware of. Definitely pros and cons with segregated funds, but it's a type of investment that's non-registered, which you actually can name a beneficiary. So I just add that in there as sort of an anecdotal piece. Life insurance, of course, you're registered in Counsel already, of course. Important to take a peek at all that. Notwithstanding some of the rollover provisions, which you're likely aware of already. For example, with an RSP, if you name your spouse as beneficiary, that money just simply actually rolls over to them. It can, at least if you wish, without any taxation. So an interesting piece, make sure your beneficiaries are up to date. And again, if that's the only thing you do today, double check who your executors are, double check that the beneficiaries are correct. You've actually put your estate plan in a pretty good set already. Obviously, there's more to do, but that would be a good starting point to get going. Wes, do you have any comments there?
No, I don't think so. I
Okay.
think this is a really good overview of some of these things, some of the basic things that you can be doing quite easily.
Right.
And when I say easy, I don't want us to marginalize the process, but I think sometimes what's challenging and what I find is that, especially with a will, when you have young kids and you got to figure out a guardian, like sometimes that's a hiccup. But when you don't have younger kids, I mean, sometimes it's hard to figure out how you want to break things down. But again, sometimes it's just you need to have something that motivates you to spend the time thinking about it.
No,
and so yeah, so again, I think the will, in addition to these beneficiaries, the biggest takeaway I think is get a will. And with the will, usually the lawyers or the professionals will also do the power of attorney at the same time, so it's super easy.
Yep.
And then, like you said, the beneficiaries I think are critical, making sure that they're up to date. I think sometimes when you might have a partner pass away, perhaps people forget about the beneficiaries because it's they're so busy doing everything else. You want to make sure that you do go back and update that. RSPs, TFSAs as well, just making sure they're set up as successor annuitants. It's not a beneficiary designation, but it allows TFSAs to be combined if a spouse or partner passes away. For folks that are our families that are on the call, we set all of these up. But a lot of individuals are not quite aware that this successor annuitant designation is something that they should be doing. They have money at the bank or what have you. And as you mentioned, segregated funds, for some folks, it's a great way if folks are saying, hey, I want to bypass probate or I want to name a beneficiary. There's some obviously benefits with segregated funds. It's a pooled investment that are generally offered through an insurance company. But again, they can be very valuable in the right situations. So I think these are all relevant. And like I said, if folks have questions, obviously reach out for sure.
That's great. Well, that's your good summary. And it's tough giving a presentation like this, Wes, because, we want to provide as much value and info as we possibly can to everyone, but we have a very broad group of people joining us today. And so, if this is a bit too kind of 101 for you, then just fire more questions. Hopefully it stimulates some more discussions. And for those of you that are just getting into this, or maybe said, oh my gosh, yeah, I really should do that. Great. Hopefully it's a little stimulus to kind of get ourselves moving. So let's fire away here, Wes. Let's go ahead and hit our next slide and see what's going on here. So we're going to get onto a topic which is pretty near and dear to my heart in terms of second properties. As Wes mentioned at the outset, we're typically focused on things like family cabins or cottages. I'm from Ontario. Don't shoot the messenger, but I do live in Vancouver, so I'm now a cabin guy, not a cottage guy. But you get the idea. I think the piece which is often not said out loud is that there's some math behind here, which we'll get into, and that's wonderful. There's some financial strategies to deal with the taxation. That's true. But the real question comes down to, is that secondary property, those bricks and mortar, those timbers, those whatever it's made of, is there an emotional attachment to that actual place, right? Is this the place that you want to see your kids and then hope that grandkids, great-grandkids are playing at or skiing into or swimming off the dock of, etc.? Is this the kind of place that's like that? Because if there's a deep emotional connection to it, then obviously it makes some sense to me. It behooves you to go and do some planning to make sure that CRA does not just force this thing to be sold. The flip side of that, I take the emotion out if it's a real cash generator. So for example, if you have a rental property, a rental building that's been in the family and you want to pass that building on, you're probably well aware if your adult kids need to sell that property to pay the tax man or woman or CRA when you pass, there's basically no way they're ever going to get back into the market, right? So I think it's kind of a double-barreled approach here that, if it suits you, it might fit the emotional side of the physical family type of property, or it could be more of the business type of cash generating property, which either way, once they're gone, they're probably not going to be able to dive back into the prop this way. Wes?
Yeah, and I just thought I would add something else, and I don't think we cover it today, but the other thing that we come across is sometimes when you actually pass it down to multiple kids, or multiple children, or you happen to be in a situation where your partner's maybe with a brother or a sister or what have you. Well, what happens when that main person passes away? Sometimes you might have one of the family members or one of the beneficiaries that want to retain it, and the other one wants to sell it. And then what happens is you actually are creating some disharmony in the family, which that isn't the goal when we're trying to deal with these estates. You're actually thinking about it from an emotional longevity point of view. And unfortunately, some of these assets that have brought a lot of joy over the years, they end up becoming kind of the sour point between potential family members or friends or what have you. And it actually breaks kind of the family down. So I think the planning about the financial piece is important as much as it is about what do you truly want to have happen, if something were to unfortunately happen to you. And these are the conversations you have to start thinking about, because again, most folks that we deal with, they want that family harmony to last, beyond their lifetime.
Well, just to jump on one of the words of our project here is about liquidity. So it's great to have a plan, but without the liquidity in the system, which we're talking about cash, without tax-free cash in the system from some way, shape, or form, it's really hard to get those gears moving to get your plans done. So that's a great point. As families grow, they become typically more complicated, right? And so having cash in the system to allow it to either be equalized and or to get CRA to kind of buzz off. That's not a technical term, of course, but you get the idea. So that's great. That's a great point. Thanks, Wes. So we're talking about capital assets here. So capital asset being the cottage or cabin, et cetera, or quite frankly, non-registered assets, which we can talk about soon too. Upon your death, there's what's called a deemed disposition. So, I mean, that's an accounting term CRA uses. What it basically means is that, let's look at your cabin at, Blackcomb, for example. If you're the sole owner and you pass away and it's your secondary property, even though you don't put a sign up on the lawn saying for sale, because that's not what you want typically, CRA puts a virtual sign and says, yes, this thing is deemed to have been sold right when you die. Now, for some of you who are a little creative, you're going, well, I know you can sell it for $1. You can't do any of that stuff anymore. It's deemed to be sold at the fair market value, right? So that's basically what some third party that's not connected would buy it for. And so as we'll look in the next slide, we can see that there's some significant tax implications of this happening, this deemed disposition. We're talking about a cabin or cottage, but also private company shares, or public company shares if they're non-registered format, secondary homes, vacation properties, rental properties, etc. Right? So that's great. Thanks, Wes. We'll pop ahead. Okay, so let's look at a very rounded example just to make the math a bit easier. Let's say that your current family cabin or cottage is worth $1.5 million. We're going to assume it's, in BC, it's all here. There's no debts. Just kind of keep this as simple as humanly possible. Now, let's say your purchase price or the ACB here, which again, I'm not trying to make your eyes roll back with technical terms, but the adjusted cost base is $500,000. In other words, that's basically what you paid for it. Now, those of you that do have cabins or cottages, you may know that you can actually, over time, work to increase your adjusted cost base. Well, Brad, why would I want to increase my adjusted cost base? Well, if you have a higher adjusted cost base, it means that there's less of a gain, which therefore means there's less tax. So, for example, we've had a family cottage, I almost call it cabin, on Georgian Bay for a long time. A new roof gets put on the cabin. Great. Save those receipts, give it to your accountant. That money you spent on putting a new roof on, that increases the cost base. Oh, we need to put new stone on the outside of the chimney to make it, more weatherproof. Great, that's a big capital outlay. It increases our enjoyment, but it also increases the adjusted cost base. So if you're smart about having these secondary properties, you keep a good track of all the money you've spent on capital improvements, and therefore increase your cost base. Anyways, we have a $1.5 million place. We bought it for $500,000. If we click ahead there, Wes, we're going to go into some math here. It's a little bit small. Hopefully you can see it. So the math works out pretty easily here for us. We take what the value is, in other words, what the deemed disposition is, the fair market value upon death, minus what you paid for it, which again is adjusted cost base. We look at that, the pointer. And we get the capital gain, which is $1 million. So there you go. That's not what you owe. How capital gains work currently is 50% of it is included. And I'll just pause there for a hot second, because until about a month ago, almost all of us thought it was going up. That inclusion rate was increasing, which has been threatened for, I can't remember how many years, but a lot of time. It's currently at 50% inclusion. The reason I bring that up is that and I think it's probably just a matter of time when this inclusion rate will go up. If that was a higher inclusion rate, we no longer multiply it by 50%, might multiply it by 75% or some number like this, which of course would mean that this math just gets worse in terms of how much is owing. Okay. But currently 50%. So we have a $500,000 taxable capital gain. So that's the amount that actually goes into the estate. Now, assuming that we're at a top marginal tax rate, that's obviously kind of a roughed out number with your federal and provincial put together. Just work with me here, call it 50% for fun. You can see that your current tax liability will be over $250,000. So hold on a second, Brad. What does this mean? I've got a $1.5 million cabin that I'm not selling, but I die. And then now my estate owns $250,000 in taxes. Can that be true? Unfortunately, it is true. So we can't change the math, but we can have some strategies together to help to solve some of this. Wes?
Yeah, I was just going to say, Canada's very proud that we don't have an estate tax, and they allow things to roll over from one partner to another, right? But really what they're doing is they're waiting. And Brad talks about this 50, the estate being in this like 50% tax bracket. And the reason why it's generally, not a bad assumption is because all of your assets come into the estate, generally speaking. So if you happen to have multiple cabins or second properties, a non-registered account or what have you, all of these various things come into your final tax return. And so you end up paying a pretty significant amount of tax. Like, if you have $1 million registered account and you pass away, that you still owe roughly $500,000 on just that. So because it's deemed disposed of. So now you have this $2.5 million estate. You actually have, it's probably more, but you have a tax bill that's probably close to $800,000. And for a lot of folks, they don't realize this. They haven't done the planning. And so they haven't figured out how that estate is going to actually come up with this money to pay for it. So, And again, this isn't about disturbing people and motivated. This is what happens. And a lot of times people get really surprised come the estate time. So this is why it's important to go back and, plan appropriately. Sorry, go ahead, Brad.
No, I was just saying back to that kind of probatable, non-probatable we talked about earlier. I mean, it's a great intention to have nothing to go into your estate, but that's not the situation. Is usually there's something owing because of what Wes mentioned, right? So, having a probate-free sort of focus is I commend you for it, but certainly, talk to your advisors to make sure that that's actually going to help, not hurt, right? Because if taxes are owing by your estate, CRA has the ability to reach back to people that have received assets from your estate to claw back the money that they're owing. They're not going to just let it sit. So again, if we're looking for ease of administration and causing less problems than before, then a bit of planning makes sense. So again, what happened in this situation? You passed away. You want desperately to pass this on to your adult children. You owe $250,000 or so in taxes. Well, usually what happens, quite frankly, and I think you probably know where I'm going with this, that usually what happens is the adult kids go, I don't have $267,000 sitting under my bed. We need to get that cash put together to make it work, but we don't have it. So what usually happens? They usually sell the property. And again, if from a pure cash point of view, the adult children are walking away with some significant funds, but that's usually not the point. Because now that place, whether it's in Blackcomb or Bowen or wherever it is, they're not going to have it. And with the money they get after paying the taxes from the estate, it's not enough money to go back into that market and repurchase typically. That's a bit of a BC situation, but it's no different in, Gatineau or Muskoka or, wherever you are doing this kind of stuff with your cabins. So having some other cash available is a strategy, right? You could say, well, I'm going to keep $250,000 of cash sitting in my bank account so that when I die, my estate can use it. Not a terrible strategy, but certainly we can do better than that. You could plan to borrow. Of course, once you borrow the money, you still have to pay it back, plus all the carrying costs, the interest and whatnot. So, again, not a terrible situation. And many people might have, lines of credit and facilities already set up to service this, but, maybe not the best option. Life insurance certainly is one way to look about it. I know years ago, we had a case where actually this kind of Blackcomb cabin situation was what it was. And 3 adult children, we talked to the matriarch about this. She said, well, you know what? This makes sense. Get some life insurance to get set up for this. That's good. But the premium was not small. She was not a overly young woman, healthy enough to get insurance though. So we actually proposed that the adult children pay for the premiums. Because even if they paid those premiums for many, many, many decades, it was still a song compared to the actual tax bill that would have to be paid. So again, using tools that create liquidity, right? We're no longer talking about assets and net worth. We're talking about ways to get efficient cash that's inexpensive cash, if you will. In other words, not having to pay interest and whatnot. Not to sell more assets, which of course then causes more capital gains and just goes around like this. So that's when we can create some liquidity to pay this tax bill. So we kind of went through that situation relatively quickly, but I think some of the notes are put forward that way. It's great to want to pass on a property in your will, and that's wonderful. But before you pass go and collect your $200, to use a monopoly sort of analogy, CRA does come and collect that tax, and it's owing, right? So a little bit of planning can make it work. Wes?
Yeah, and I know I want to be mindful of everybody's time who's joining us. So we're in the home stretch here. But I did want to make a quick comment about what you were saying there, Brad. To generate cash to pay a tax bill is one thing. But you can also, again, through proactive planning, if you do the calculations and you recognize that, you're going to lose, let's just say to keep easy math, $500,000 to the government, as an example, which means, I don't know, let's just say you have a $3 million estate, 15% of it's going to go to the government. Well, what you just said, and I think it's actually really smart, if you actually can create that cash to pay for it on pennies on the dollar. So as an example, if you had I know a lot of people are indifferent on insurance sometimes, but if they're just looking at what they're going to pass down to their kids or the family member, whoever it is, you might be able to offset $500,000 of tax for $150,000 of premiums over your lifetime. So you've effectively cut your tax bill, down by almost 70% by doing proactive planning. Because at the end of the day, like you said, the CRA is going to take it regardless. It's just how are you minimizing it, or how are you effectively passing more assets down to to your beneficiaries and less to the government. And so if you had to choose, I know most people would choose not to pay CRA. They'd rather give it somewhere else, charity, premiums, whatever it is. But in any case, these are why we have to have these conversations to explore whether these things make sense. And if they don't, then you just check it off and you move to the next solution. All right. So
Perfect. Now, this next section, again, this may or may not be applicable to your situation about kind of your corporation and how it works, but we just thought it'd be helpful to maybe kind of broaden the discussion a bit. For those of you that do have corporations, it could be a holding company, an operating company. We're just going to talk a little bit about how, if you do have wealth inside a company, so, it can be an investment account or other kinds of shares or other kinds of assets, how we can get money out on a tax-free basis. So cognizant of time here, we are going to kind of go through this relatively quickly, but of course, if there's questions about it, then just let us know. Just to briefly go through this, we have our oval type shape here, which represents the company. So this could be your, holding company or whatnot. Again, if you're not sure what a holding company is, it's simply just an incorporated vehicle where assets are held, right? So it's typically not an active business, although that's a discussion for a different day. And inside that, typically you've got options. You have money as cash, you've got some kind of real estate holding, you've got some kind of investment account, et cetera. You may have other companies which are connected to it. Not to get too crazy, but let's just simplify it here. Money gets made, it gets put inside. Now, see, there's your family over on the side there, all happy under the sunshine and a little tree. We want to get money out to them, right? And so the reality is, and if you just kind of start going through this a bit, Wes, all this money here is taxable, and that's no big surprise, right? Any money inside your corporation is taxable. The tax rates kind of depend on what's going on in there, but it's taxable. There are options inside a company where we can actually shift money from this taxable zone into a non-taxable zone. The only game in town inside a company to grow money without paying tax on it is inside what's called investment grade life insurance. So it's a life insurance policy. It could be similar to one you might have personally, which has some cash value to it. Wes, we just kind of go ahead a couple here. We shift the money into this policy. So it's still within the confines of your company, but what it does, it helps to grow going forward without attracting any tax. It's kind of nice. Whether the other investments are there, they're still causing taxation. Now, to get money out of our company, anytime you pull money out of a company, there's obviously some taxation. That's just the way it goes, right? So Wes, you just go ahead to the next slide too. When money comes out of that company, there's always taxation, whether it's a dividend or some kind of salary or some kind of draw, that's just the name of the game. And if we go to the next slide, what's kind of interesting is that the insurance policy, when it pays out, so in other words, when someone passes away, it creates a tax-free benefit to your company. And that benefit can kind of come out of the policy, can come out of your company to your family who are shareholders tax-free. Go ahead to the next slide there, Wes. So there's a thing called the capital dividend account. The name of it doesn't really matter. We call it the CDA just for fun, but kind of think of it like a straw. If you have a company and there's assets in the company, you want those assets to get out to your family, you could do that today, but it's going to be taxable. If there's a paid benefit from a life insurance policy inside your company upon your passing, for example, that money can flow out of the company to your shareholder spouse or family members on a tax-free basis. It's not going to get all the money out, but again, it provides liquidity, right? It's a tool that can be used to augment this and kind of flow money out on a very interesting kind of basis. Interesting stuff. Wes?
Yeah, and I think this is, we talk about this. A lot of our families are familiar with this, but for those of you that aren't, the Income Tax Act changed. I don't know if you recall, if you are incorporated or have a business, about 5, 6, 7 years ago, maybe, there was a fairly significant shift on how corporations were taxed. And if you made too much money within the corporation, you lost your small business tax and so on and so forth. So these this is a vehicle in addition to your investment accounts or real estate or whatever that allows you to tax shelter an investment within your corporation. And it doesn't affect your small business tax or your small business deduction, I should say. And effectively what you're doing is, for folks that maybe, again, I'll just use simple math. Let's say you had $1 million within your corporation. Well, if you're investing it within the corporation, you're earning income on it. And you're paying tax along the way. Passive income, by the way, folks, in a corporation is taxed at 50%. So you're losing almost half of every dollar. It doesn't matter what you're earning. So by having it sheltered, now it's actually growing. You're actually minimizing the tax. And then you're effectively getting money out of the corporate on a tax-free basis. So you're going to have to pay tax regardless when you take it out if you do nothing. But this is a more creative strategy that you can say, hey, I do want to get it out. I do want to minimize it, take advantage of the CDA, the capital dividend account. There's only roughly one or two things that you can actually utilize the CDA account for. This is one of them, and it grows over time. And really what you're just doing inside the corporation is you're just reshuffling your investments. So think of it this way. If you were to all of a sudden this year buy Royal Bank for X amount, instead of buying Royal Bank, you might just tax shelter that investment within this estate or investment grade type of life insurance. You're still investing it, but it just has a lot of tax benefits. You can save it along the way. You can borrow against it. It comes out at estate time. So again, it's a lot to unpack in this short period today. But for those of you that have corporations that you have not talked about this about, then you need to have this conversation because you could be missing a tremendous tax deferral and it's right under your nose. So the first thing is just learning about it and seeing if it even makes sense. So
well, that's a very, 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 very well said. And we can just kind of advance the slides because we're almost kind of in the home stretch here, as you mentioned. So, I mean, the whole point of all of this is that, number one, none of these ideas are new. None of these are the new shiny object, which, get in quick. These are all foundational pieces of estate planning in Canada. Whether we back way up to talking about your probate planning, use of beneficiaries, this stuff's not new, but it's unfortunately simple tools in the toolbox that, for whatever reason, people just fail to take max advantage of. I like efficiencies, and by missing the efficiencies, we're just giving away too much money, which just makes no sense to me. We can go to the next slide is to there, Wes. When we talk about cabins and properties, same thing. Taxes are always owing when these things, when people pass away. If we understand the mechanisms of it, and then just put a little bit of mental juice towards providing some kind of solution, boy, we can provide liquidity. And forgetting all the math, make sure your plans are played out the way you wish, which is the whole point of this. You worked super hard for your assets to build that. Why would we get almost to the finish line and have all that hard work not go exactly where you want? That's kind of how I look at it. And then the following slide there, Wes. Oh, you're chopping the bit.
I just wanted to comment really quickly on the second property. So, so again, this is one way to help offset or keep it in the family. For those of you that are like, I have a cabin and I have a cottage and I haven't really addressed this. Just to let you know, again, reach out. I did a session about 2 years ago where I think I had 7 or 8 kind of key takeaways in addition to the insurance piece about how we might be wanting to addressing second properties. And again, a lot of it is planning. You have to plan ahead of time rather than, at the time of the disposition. So this is probably the most efficient way is what Brad's talking about, but there are some other things that, again, if you haven't discussed it, then again, send us an email. We can always connect and teach you.
Very well said. The idea is to kind of crack open the discussion because everyone's got their own nuances of what's going on here. And of course, if you do have a corporation, it's very critical to, know about the tools available to you, to things like capital dividend account, to make max use of what's going on. And with that, it's 2:00. Boom. Thank you very much, Wes. Thanks for having us in here. I'm sure there's a million questions out there that we can't address today, but we certainly can do our best to answer some of them.
Yeah, and thank you very much, Brad. Like I said, really appreciate, very informative session. I think for folks that are on this call, they might be thinking, wow, this is a lot of info. And it is a lot of info. And I think the purpose of it is to say, hey, if you're interested or it's just scratching the surface, we got to start having these discussions. So we did answer some questions along the way, which is great. There are a few here I'm just going to throw out there. I'm also going to move this presentation back to the slide of our legacy estate guide. I had somebody say, can you go back to that so I can just find out where it is? So folks, apologies. This is going to flip through here. So just I'll do my best to get to it. So just a couple of things. So one, somebody asked, do you recommend just putting the children on title of a property before the parents pass? I assume you're talking about a principal residence rather than a second property. Brad, you might have a different opinion. I might look at it a little different, but when you add a child to a principal residence, or anybody else for that matter, obviously you have to be looking at the taxation. But the other thing that a lot of people fail to think about, and it's not just a property, it could be an investment account, it could be your bank account or what have you. But you give up, there's two things. One, you give up some of your control, because now you actually have another entity or individual that can make decisions on that. If it's an investment account, they could basically make a withdrawal because they are an owner. But the bigger one is you actually open it up to creditors. And there has been some court cases where a mom put her son on the home, and he had financial issues, and his creditors came after him. And because he was a partner on, or because he was an owner on the home, they actually attacked the home. They wanted to seize it, went to court, and they decided that they didn't want to create any hardship for the mom. So they let her stay there. And when she passes away, his creditors will take that home. So yes, it could be an idea, but you have to be aware of all of the implications about having somebody added to a property that you own. I don't know if you have any comments on that, Brad.
No, I agree with you 100%. I like when people are thinking about planning ideas, but please get some professional help to kind of vet those ideas and make sure there's not some unintended consequences like you're mentioning.
Yeah. I have a couple questions on that. You alluded to it a little bit earlier, Brad. I'm hoping you might be able to make a couple comments. Can you discuss, if you're comfortable with it, executors, maybe it's kids that are in the US. So your kids are named as your executor, but they're living in the US, or maybe it's a sibling that's in the US. Any comments about how that might impact the estate process with a non-Canadian executor?
Definitely I'm going to dodge the one a bit because I'm going to say I'm not a lawyer, so please speak to your lawyers. However, it's not going to make it easier. Let's just put it that way, right? So I think jurisdictionally, if you're based in BC, for example, having an executor that's based in BC is absolutely the simplest way to make things work. Having executors not in Canada is not impossible, right? Especially if you have a much larger estate. There could be some other aspects that might make that make sense. But yes, I would highly recommend having somebody local to assist with that. But again, to dodge that a bit, good question, but I would definitely talk to your lawyers about that, double check.
Perfect. Let me see what else we had here for just a quick. I think we've actually answered quite a few. I'm just going to bring up the one slide there. Sorry, I was clicking through it. I know there was an easier way, but tech savvy is not generally used when they talk about me. So we managed to get that there. Oh, and this is another one. Somebody said, do you recommend having the same lawyer for the estate as your spouse? So should the two spouses have separate lawyers? To be honest, I've never really come across that. I don't know if you have, Brad. Generally, it's one legal team. Your office is generally the one that helps with the estate or the will or the power of attorney. Obviously, if they're separated, it obviously might make sense to have two separate ones. But when it's in one household, I haven't come across a situation where we might have two separate lawyers. I don't know.
I would add in though, like with that multiple will strategy we alluded to, if you do have significant assets in the private company side where there's maybe other owners and other kind of complexities, then it might make sense to actually have two separate, kind of one for personal, one for corporate. But again, that's on a case by case basis.
And that's if you're using a multiple will strategy as well.
Exactly. Yeah, I don't see it very often, but it certainly does happen sometimes.
All right, I'm just going to follow up with one last. And again, I really appreciate everybody who's stuck around here. We went a little bit longer, but again, great topic and good interaction. So I want to talk a little bit, and again, we can talk about this for 20 minutes. So unfortunately, we have families where a spouse passes away. Now we have a widow, a widower, and the importance of updating the will, the beneficiaries we talked about. But what about if they remarry? Any comments? And again, I know we're going to say, hey, we should be going to the lawyer.
Yeah, of course. Yeah. No, I'll try to actually give you some kind of answer, but you're right. So Family Law Act in BC was updated a very small handful of years ago. The Family Law Act, for a lot of very positive reasons, supersedes, goes on top of, and kind of pulls apart a lot of the WESA estate planning laws. So getting divorced, separated, whatever, doesn't actually change your will. Getting remarried in whatever way, shape, or form that looks like, common law, marriage, etc., it doesn't matter. It can dramatically affect negatively whatever will and estate planning you've done. So yes, getting remarried absolutely changes things. If you get divorced, though, just as kind of a matter of principle, it would make a lot of sense to update your will too, because your money's still going to go where you kind of maybe had planned for it to go before said divorce. So yeah, any kind of major life change, of course, go and get things updated. Absolutely. Yeah.
Well, and again, I think what we're, as I'm here listening to you, blended families maybe where, if you do get remarried and they have children and you have children from your first marriage or what have you, that can create a lot of complexity where maybe the money doesn't get to where you're hoping it does. Maybe you want to have it go to your kids or vice versa. So yeah, I think it's really important. Again, what you're saying is estate planning is fluid. And so rather than just doing it once and tucking it away and we don't look at it, it's something that needs to be reviewed on a somewhat regular basis, especially if you have lifestyle changes. Just like your financial plan, it's important whenever you have changes to your financial situation, you need to update it and sometimes reforecast. So I think it's a great comparison to the estate side of it as well.
Maybe as a final note, that the corollary between a financial plan and estate plan, I mean, it's not about the product, it's the process, right? It's a living, breathing document that just like you and your own financial world, it changes over time. These things need to be kept up to date, which is why connecting with, Wes and your advisors is super critical on a regular basis. Obviously updates on your investments and markets and assets, but what about the other stuff, which isn't quite so fun to talk about like this? Super critical. And most importantly, as a takeaway, more of your money will get to the people you love the most if you do just a bit of planning. So maybe that's the way to end it, Wes. And I want to thank you for having us over today. It was great to chat.
Yeah, I really appreciate it. Thank you, Brad. Perhaps we get you on the call again. I think this was very informative. And again, folks, I really appreciate you joining me on a Sunday, Tuesday afternoon. I'm not sure if we'll be doing a session in August. We'll see how it goes. Obviously, people are going away on vacation. So we don't have one in August. We will do one again in September. So I wish you guys all the best. Have a great summer. If people do have questions, please send us an email. I know there were a couple of questions in here that we will get back to folks. We couldn't answer them all. Great response. So thank you very much, guys. Everybody have a great day, and we'll talk to you very soon. Take care.